All right. Well, good evening, everybody, and welcome to tonight's special edition of Turnout Tuesday. Uh, my name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by my friend Ken Kavula, accomplished investor and educator from a few miles to the north, although now I think he's basking in the Smokies. Is that correct, Mr. Kavula?
I'm down about 20 miles north of Gatlinburg, Tennessee, just outside the Great Smoky Mountains Park. If you know the park, folks, I'm out near Cosby, and my wife and I are experiencing an absolutely gorgeous couple of days. We're going to be down here for the next week or so yet.
And I was serious. I did wish that I'd had the opportunity to stow away and go with you. So I wasn't kidding. Well, tonight's session, Ken and I basically want to keep visiting the subject of selling discipline and this notion of, and tonight we're going to spend a little bit more time talking about excerpts from our recent presentation at the National Convention for NEIC Better Investing, and this notion of quality and how it might trigger some, I don't know whether we should call it proactive or certainly perhaps potentially effective uh, money saving or return bolstering ideas, and that's what we really want to talk about here tonight. Both of our email addresses are on the slide, kkabula1 at comcast.net for Ken, markr at manifestinvesting.com for me if you want copies of the slides or if you have follow-up questions, comments, or suggestions, because this, again, as you'll hear us say here in a minute, it is a work in progress. A lot of the stuff that we're talking about is literally steeped in the teachings of the National Association of Investors, the Modern Investment Club movement. That's why you see the NEIC Investors Manual on the screen, and it is tackling this notion of selling and doing better over the long term. A little bit of legal housekeeping before we get started. No investment
Mark,
recommendation is intended.
Before you get off that home screen, Mark, folks, you're going to be getting an email, a reminder email for our program in July. And we're not quite sure of what the date will be, but the headline for the email will be Turnout Tuesday is not Tuesday this month, because in July, the first Tuesday is the day before the 4th, and we don't think that's going to be an exactly good day to run an investors program. So we'll be setting a different date. It probably will not be a Tuesday, but we'll make that clear in the headline. The program will be the same. It just won't be Turnout Tuesday. Might be Turnout Monday or Turnout Wednesday or something like that, but we'll keep you informed.
Sort of like when they do Thursday night football on Saturday morning or something.
You got it. Same thing.
All right. As always, you guys know the drill. No investment recommendation is intended. This is all about education, and it truly is, in this case, a demonstration of a work in progress, but we think it's in some ways, and I know, Ken, you echo this, some of the stuff that we're discovering and actually scratching our heads and thinking about is a work in progress going back 60, 70 years. So we're kind of excited about that aspect of it. If you do want to be added to the webcast reminder list, or you have a friend that would like to, nkavula1 at comcast.net at the bottom of the screen there. Natalie will take care of you. All right, so let's go ahead and get underway. We're talking about selling better. Ken, would you like to kick us off here a little bit?
Yeah, this all began with the idea of Mark and I wanting not only to preserve capital, but to preserve capital gains. We think that's an important sentence to kind of keep in the front of your head when you're investing. You don't want to just throw capital at a problem. You don't want to buy high, sell low. And when you've made great capital gains, you don't want to give them all up chasing a stock that might go back up, but in a lot of cases never does go back up again. So we were looking for triggers, simple triggers, and they weren't going to automatically tell us to do a sale. These triggers were going to be used to bring the stock to our immediate attention and force us to think about whether or not we had sufficient reasons to sell. And we want to go back to the time-honored reasons for selling, the discipline that's been taught to NAIC investors since the early 50s, the discipline that Mark and I 100% believe in, It's just that tools have changed in the last 65 years, and we think that if Mr. Nicholson and Mr. O'Hara and some of the other gurus were still investing today, we think they'd be keeping track of things in a slightly different way because they had more advanced tools, and we think that they'd be using the tools that were available to their utmost. They wouldn't be relying just on one or two things, but they'd be looking at a whole series of different things to help them with the idea of selling. Selling is the most important thing that an investor can do, judicious selling, and it's also one of the most difficult things for us to learn when to pull the trigger. Mark, I think we have a slide that talks about the three basic reasons for selling. Why don't you take this slide?
Okay. And I substituted Snoopy and Woodstock to keep us less formal. But again, selling a stock is not un-American, just as it says there, but don't be stubborn. That's one of the things we talk about a lot in the roundtables. How do you tell the difference between when you're being stubborn and again, don't let the taxes get in the way either. We can tell nightmare stories of trying to avoid the taxes on capital gains, and then in the meantime, watching our investment plummet like a Roman candle. But here are the three reasons that we believe in. First of all, you need the money. This can be for any reason. We're not going to spend any time covering this. We just simply think you stack up your portfolio, you make sure your guides are up to date, your stock studies are up to date, and you seek the ones that have the lowest return forecast, and then basically begin selling until you have enough money. Hopefully, stopping selling and having enough money before you run out of portfolio. The second thing is because things are going badly. And this is what we're going to talk about with kind of a 2A and 2B approach here tonight. This is that notion of things going wrong or the company misbehaving or inexplicable things. A lot of things can happen. We'll talk about quality, define it, and then talk about the impact on quality and show some graphs. But again, this notion of something going wrong with your original assumptions, and sometimes is way out of your control or opportunity to see it coming. So things just simply going wrong, we want to be able to watch for that and have some rationale. And last but not least, we spend 90% of our time doing this, basically taking the portfolio and making it better, improving the overall returns, improving the, keeping the portfolio quality up so it protects us from bear markets and corrections and recessions. And then we also want to keep enough smaller companies, smaller, faster growing companies in there to keep the sales growth forecast boosted up. And that is an area that we've seen fairly dramatic improvement here over the last several years. Many of the clubs that Ken and I are affiliated with have benefited from keeping a strong portfolio with enough small, faster growing companies in it to accomplish the objective and basically have enough growth to support enough return. So again, this notion of make the portfolio better, swapping out one stock for another. So again, 90% of the decisions you'll make will be on that number 3. We'll watch these during the roundtable and during some of the other portfolios that we share with the audience. But again, that's the whole notion. Be prudent about it and be diligent about it.
Mark, there's a word on that slide that I think is really important because I think sometimes people in their own investing, their personal investing or in the investing that they do as a part of a club, confuse stubbornness with patience. And patience sounds like a much better virtue to have, to be patient about a stock. But I think that some of these triggers are going to force us to ask ourselves, are we still being patient, or has our patience turned to being just plain old stubborn? And I think being stubborn will eventually lose us money. There's a place for patience in investing, but when that patience turns to stubbornness, I think we need somebody to nudge us a little bit and to say, at least rethink your position from the ground up. At least rethink the reasons that you're holding the stock and what's going on with that stock. And if you still think that you have a great company, then continue to hold it. But if you can come up with a number of reasons why you can find a company that's better, somewhere else in one of the other sectors or one of the other industries, then maybe it's time to give up on certain things. I know that applies to the rule of five. We're going to talk about that on a slide that's coming up real quickly. So I'll shut up here for a moment and let you go on to the next slide.
Yeah, and you're also reminding me that one of the things that we want to point out, and it kind of falls into that stubborn category we shared with the audience in Orlando. You know, many of us have been either with our individual portfolios or in a club meeting where a month before we bought a stock at 100, we came back in the next month it's at 80, and we're always tempted to say the expression, "Well, we liked it at 100, we must really like it at 80." And I think there's a danger zone there, and that's one of the things we want to look at. You know, what if the stock market has gone up 20% in the last since you bought it at 100 while your stock's gone down 20%? Something's wrong. Something is amiss, and that can be a very powerful discipline to really nudge us and taking a closer look. Again, if we liked it at 100, we should really like it 80 isn't always necessarily the best perspective on the situation.
And Mark, not all stocks that go down are necessarily buying opportunities either.
And that's right.
I hear that one. I hear that one all the time. It's a buying opportunity. Well, many times it is, but there are many times when it isn't as well.
Yeah, we're going to look at a really painful one here in a minute for me that definitely captures that moment. So again, we often ask the question of our audiences, what's the most important tool for portfolio management? And believe it or not, it is the stock selection guide. It's the complete stock study, including the results of a stock selection guide, which has a return forecast as the bottom line in section 5. So every time you hear us talk about PAR, projected annual return, that's one of the components or one of the things featured as a return forecast in section 5 of a stock selection guide. So we throw around the term PAR quite a bit. And in fact, some of you in the audience, you know who you are, probably place quite a bit of emphasis on the upside downside ratio in those words, buy, hold, or sell. We just encourage everybody, and it's been the way I've been teaching this now for 25 years, that, yeah, Section 4 is okay, and all that other stuff is okay, but the real bottom line and most compelling or guiding output of a stock selection guide or a stock study is that return forecast known as a PAR, projected annual return. And so we just encourage everybody to recognize that a current stock selection guide is important. What you're looking at on the right is what we refer to as a chronicle at manifest investing. All that is simply is a snapshot. You're looking at monthly snapshots starting back in April 2014. The green bars are the stock price. The blue, which we'll be spending a lot of time with here tonight, is the quality ranking. It's a percentile ranking from amongst all companies, and anything above 80, anything up in this range is excellent. In the top 20% of all companies, you can see that Costco is up there consistently, and it has basically maintained an upper 90s percentile ranking for quality over that entire time frame. The red is, again, the bottom line of any stock study, the return forecast that you're looking at, again, fluctuating from left to right, up a little, down a little. The buying opportunity is on the left-hand side for Costco. These peaks could be potential buying opportunities. But again, what you're looking at is a snapshot of a consensus stock selection guide as if it were prepared by the analysts covering Costco on a monthly basis, and we keep track of it over time. Stock prices fluctuate, so do return forecasts.
Yeah, the math teacher in me, Mark, wants to also emphasize not only on this particular piece out of manifest investing, but on the online tools that we use on a regular basis. We look at graphs all the time. And I found when I was teaching my courses at convention this year, I taught 80 plus people in a beginner's course, and I found many of them ignored the scales on these graphs, so that graphs that looked really steep and really jagged had really short scales to them, and that just kind of makes the peaks and valleys emphasizes where they are. As the scale gets bigger, the graph tends to kind of smooth itself out. Look at that par scale on Costco. The 0 is down there, leaving us some room for some negative numbers, but it only goes up to 10. So this is a par value of only between 0 and 10. What we're saying is Costco doesn't go on sale very often. Costco's not a particularly compelling stock for us to take a look at in very often. And when the par does go up around 9 or 10, that's a historically high value for it to take for potential annualized return. So watch those scales on these graphs. I know this graph looks awfully roller coaster-ish, but it's actually roller coaster-ish in a fairly narrow range, 0 to 10. Those scales sometimes will go 0 to 20 or 0 to 30 or even 0 to 40, depending on when and where and what the stock happens to be doing over the last 4 or 5 years.
That's a great point. I mean, we've always looked at companies like Johnson and Johnson and watched it rarely go into double digits for the return forecast. So, yeah, Costco. It'll be interesting to go back and see what Hugh picked it at back in the early days of the roundtable, because I'm pretty sure it was McManus picking Costco back about 8 years ago. See what the return forecast was at the time back then. I'll make a note. All right, so let's go ahead and talk about when things go wrong. Basically, part 2 of our reasons for selling, and I've retitled this because of the unexpected or in some cases inexplicable things that are going on. And this part, we're only going to spend just a couple minutes on it. It has to do with the relative return performance of any stock that you buy compared versus a benchmark like the Wilshire 5000. So you want to be looking at, how your investment compares to the relative stock market. Now, this is inspired by the guy who created Investors Business Daily, William J. O'Neill. In fact, I got a chance to interview him a few years ago, spent some time with him. One of the rules that they have in their CanSlim process is that any stock, if you buy any stock and it drops 7 or 8%, you just simply sell it. No questions asked. It's a protective measure. Now, keep in mind that much of what they do at Investors Business Daily is momentum-based investing. So what they're basically trying to do is slam the brakes on for a stock that is not cooperating when it comes to the positive momentum side of things. But we're investing, not trading. And Ken and I sat in a room or on the many highway miles that we've shared together and talked about how 8% might be a little bit low. And then also this notion of, again, I think you got to, as an investor, you need to talk about, like it says there in point 2, if the market drops 10% and your stock drops 8%, you're actually ahead of the game. Might not feel like it, but I think that 8% drop is a whole lot different than if the market had gone up 10%. So again, we want to be comparing how is our stock doing versus the market, and how do the prospects look for a company like this. So again, our notion, and this is very important to us, is we want to keep it simple. We don't want different numbers for different kinds of stocks. We just want to try to find a number which doesn't generate a whole bunch of turnover, but does provide some protection against things just going wrong. So we track the actual relative return, and we suggest initiating an audit. Basically, trust but verify, check the numbers, and do a selling analysis when the annualized relative return reaches minus 20. So if the stock market is flat, 0% return, and your stock goes down 20%, we think you should kick into a soul-searching and honest, disciplined consideration of selling it. Anything you would like
Mark,
to add to that, Ken?
Yeah, I think that something that we need to add to our turnout program here in the next month or so, maybe for July or for August, is how to do that thing in the very bottom box right there. Because that's where a lot of people kind of are looking at us and saying, well, I don't know how to compare the actual return of my stock to the Wilshire Total Stock Market Fund or the Vanguard Total Stock Market Fund, something like that.
Hmm.
So maybe what we'll do is 20 or 30 minutes on how you can actually do it in a fairly easy way using a free tool or so available right on the internet.
Sure, and we're actually going to look at a picture of one of those now that's not straightforward except for people who really like pictures, but we can take a look at the spreadsheets that we use and the picture you're about to see. But yeah, actually walking through and describing that. So here is one of those tools. This is my story from I nominated Iconics Brands, ticker ICON, for the roundtable back in, oh, I don't even remember. I'm having protective loss of memory here. April 2015, I think, or May 2015. And at the time of the study, by the way, it was a perfect study. It was one of the best studies in the history of the roundtable, probably one of the best stock selection guides in the history of man. But Superman S on my chest and everything. But for some reason, the company was uncooperative. It's not that I was wrong. It's just that for whatever reason, the market and the company was uncooperative and failed to fulfill my ambitions. And what actually happened was we during that, you can actually go back and listen. We actually talked about this notion of, if this doesn't work out, we're going to get out of Dodge if we lose 20%. And I'm talking about that relative return number. So again, $1,000 invested in ICON back in April 2015. Just 4 months later, it had dropped down 20%, basically. It was lagging the flat market by 20%, and we did get out of Dodge. We left with our $800 and cashed out, and as you can see, it didn't get any better. That $800 in our pocket, if we had been stubborn and said, you know what, we loved it at 1,000, it was, by golly, Mark did do the best SSG stock study in the history of man in the roundtable. 800, we got to really like it at 800. If we had stuck with that and been so stubborn that we were still holding it today, and Ken, you're going to enjoy this because I think it was $60 in Orlando. It's now $34 here on June 4th. So it's, that $1,000 has shrunk to 34. So our point is here, this is one of those examples, and we've got a few of them now, of we actually left this party. We called timeout. In fact, I'm learning more about timeout again with my 1-year-old and 3-year-old grandsons. This is a situation where calling timeout would have saved us a whole lot of capital. And it's a painful story. It continues to be painful. Any comments or rubbing of salt in wounds on this one, Ken?
Well, I think, Mark, if you go to the next slide, we can tie things together with one of our time-honored principles. We've been teaching stock selection guides and investing and when to sell and all kinds of theory. I've been doing it for almost 25 years now with Better Investing, and Better Investing has been talking about the rule of 5 for the last 50 or more years. Basically, the rule of 5, as most of you already know, says that when you pick 5 stocks at random and prepare conservatively reasonable SSGs, 3 of those SSGs will tell you exactly what the stock's going to do. One of them is going to be a surprise to the upside. In other words, the stock's going to do quite a bit better than the SSG suggests, and one of them is going to be a disappointment. And finding out a specific reason for the disappointment is many times almost impossible. I've sold stocks based on the rule of 5 because I've held them for literally years, 2 or 3 years. I've watched the market go up huge percentage values, and I've watched the stock language or even gone down, even though it's a high quality stock with great trends in growth and great trends in management characteristics. For some reason, the market just doesn't like that particular stock and punishes it with no mercy. So I'm suggesting that Iconics was just one of the rule of five. It was the one you want to get rid of. And maybe that's a nice simple way of saying that we're hoping that our 20% drop trigger is going to help us get rid of the one that we want to sell. The beginners class at Orlando, they didn't have any problems understanding the fact that if you could get rid of that one out of every five that wasn't going to perform, you were going to have a better portfolio. And I agree with them, and I agree with Mark when I'm saying that this trigger that we're talking about is just a great example of getting rid of a stock that, for whatever the reason, and many times we don't know what it is, the stock just doesn't perform. Mark, can you actually place your finger on a single reason or on a list of reasons why Iconics is doing what it's doing?
Well, no, it's kind of like I kind of am in ignore mode. I'm mad at them. I'm disappointed. I'm bitter. So I don't really care anymore. So no, at some point I am going to go back and look and see what went wrong. But there's a number of executional things, and from the wisdom of our young people, I'm reminded of a few years ago we had a young man by the name of Jason Ramage. This goes back. He's now graduated college and he's actually working in an investment related field. But this was probably back between high school and college. He said his approach to the rule of five was really quite simple. He just didn't buy the fifth one. So, the wisdom of the young people in Orlando and Jason Ramage in this case. Just a final point on this: we were seeing rule of five type math, both in the tracking portfolios that we're talking about. We pick between 50 and 60 stocks per year for the roundtable. We're seeing again this inexplicable misbehaving. Children needing a timeout, from 8 to 10 of them per year, and that really does line up mathematically pretty well as far as the frequency goes. Same thing for our monthly selections and for the Fave 5 that we saw. So again, we see it kind of coming true. This is kind of an answer to your question, Ken, and a little bit of a nudge that kind of links this place where we're starting with this relative return concept up with the quality. This is the chronicle for Iconics brand. And you can see that the quality was actually headed in the right direction on the left-hand side of this chart. This is a fairly strong trend, but you can also see that trend reversed and went south pretty strong. And again, we're going to be talking about that for
pretty
some of the
quickly
companies,
too.
Yeah, some of the stuff that we follow. I mean, the price actually led this down. We're not seeing that very often with the companies that we're doing some research on. A lot of times the price action lags the change in quality, but here's a case where the herd was jamming their way out the exits while the company fundamentals were still actually improving. But then you can see from that bump up in the return forecast bumped up and spiked in the middle of the chart that you can see here. Notice that as the price continued down, section 5 basically fell apart also. The wheels came off, and a whole bunch of things went wrong with this company, all the way down to that big drop towards the right-hand side here, this big drop in stock price, and this bump up to a return forecast that begins to be compelling, if not too compelling, too good to be true. One of the other lessons that I've learned as an investor, the hard way, is that if I sell a company like this, back on the left-hand side and enjoy tremendous gains, I'm not getting back in while this quality trend is going down. I'm not going to do that again in my lifetime as an investor. If the quality trend is down, you want to stay out of the way and don't let this type of return stuff. Notice the scale Ken was talking about a few minutes ago. We're talking 40% annualized returns down at those lower numbers. Those are just, it's asking for trouble. It's temptation personified. So again, watch out. If the quality's going down, it's not time to throw good money after bad, perhaps. All right.
So let's take a closer look at quality, because we've been throwing that word around quite a bit. Quality was first defined by some of the people that we revere as teachers to growth and value investing. We go way, way back in academic history to a lot of the founders. Nicholson was a firm believer in a lot of what was being written in the 50s and 60s about growth investing and value investing. And I think that he kind of put into words what he thought made up a high quality stock. We think that these drops in quality are just reflective of some of the basic fundamentals that are involved in a company. And since they're basic kind of fundamentals, we think that they are nudging people to the place where they're not willing to pay as much for a dollar of earnings as they might have been 3 or 4 months previously. If you listen to that sentence that I just said, basically I was describing PE values, and PEs are starting to drop when quality drops. And when PE drops, then earnings don't have a chance to move very much. Remember, earnings for PE purposes only move 4 times a year. Then the only place that the stock can adjust is in its price. Mark, I think you have a 4 pillars slide next, don't you?
Yeah, it's coming up, I think, in a few slides, but I just wanted to reinforce what you
Okay.
just said, because the quality of a stock, the quality ranking, and the PE ratio literally are joined at the hip. So at some point, a drop in quality is gonna drive a drop in PE. And just like Ken said, and sometimes what he's pointing out here is sometimes there's a lag, and be watchful for that.
Now, this idea of watching quality, again, we want to make it perfectly clear that this is a work in progress. It's a hypothesis, and we're testing the hypothesis. And we're going to show you some examples, but the examples are anecdotal. That means there's not enough research there yet being done by us to say for certain whether any of these things work on a regular basis. In investing, there is never anything that's for certain, but if we can find something that helps us 80% of the time or 90% of the time or even 70% of the time, we might be onto a useful tool. We're going to be testing all these things with some imaginary portfolios. We maintain for the public to watch a roundtable portfolio, and then Mark maintains on his website a number of different portfolios where we can take a look at what these triggers would force us to do, and whether or not a year later or 2 years later those triggers were actually helping us increase return or not. Mark, I think the next slide is where I was going to take some time. Yes. Here's our first anecdote. Here's where the idea first kind of fell into place in a very vivid way for myself, at least. I owned this stock for a while. I had great confidence in it, and notice for a long time on this graph, notice that the quality stayed up around 100. It was a really high performing stock. And then somewhere in 2015, the quality took a nosedive. If you're wondering what might have happened in 2015, well, part of it, I think, had to do with a company called Apple, and with a watch that they were preparing to market that was going to change the way you viewed that thing that you wore on your wrist. Now, at that same time, my grandchildren were telling me that watches were still being worn, they were still coveted, and they weren't being worn to tell time anymore. They were being worn as fashion statements. I knew that Fossil made fairly inexpensive watches under many different fashion brand names, and I still had faith in Fossil. Their quality dropped in 2015, and the average price went from somewhere up in the 60s, 70s, 80s to somewhere down into the $45 to $50 range. I added that red line to the graph to kind of help you see. So after the quality drops, you might notice that there's 3 or 4 or even 5 months before the price precipitously drops after that. So the quality drops. I still have a large amount of time to get out of the stock. Let's say I get out at $45 and I save some of my capital. Well, the quality kind of stabilized a little bit and then took a small drop, stabilized again, and then took another huge drop. And when it takes that huge drop, then the price moves down to $10 or $15. So what might have been $100 invested was cut in half after the first quality drop, but then it was cut by 85 to 90% after that second big quality drop there. Well, so our question to ourselves was, is this graph telling me the same kind of things on other stocks when the quality falls in such a precipitous manner? So we started looking for other examples.
Yeah, and again, I just want to reinforce that the quality ranking is 100 percentile from top to bottom. So the companies that we regard as excellent are between 80 and 100, as you can see on the left-hand side. And one of the things that we're asking, we haven't actually come up with any hard and fast rules, but we do think that these breakpoints between excellent at the top here, the next one down between 60 and 80 is good. We do wonder a little bit about those as being potential milestones or thresholds. In this case, as this company dropped below 90 and then dropped below 80, should we have, and in fact we did, and you can actually go back and listen. Ken actually exited some of his positions back in that time frame, fearing the competitive threat from Apple, and that's part of the point I want to make is this is not witchcraft or anything else. It's relatively unemotional. Again, keep in mind that the quality rating comes from these four major pillars. It's unemotional.
Mark,
almost.
We're getting a question. We're getting a question, Mark. Where can this graph be found? These are chronicles, and they're attached to every single stock that's followed in Manifest Investing. If you're interested in looking at Manifest Investing, you can go to the website, and if you put your name and your email address in, you can get 3 months for free just to explore it and take a look at it. Mark, are you going to define quality, or you want me to take care
Well,
of
I
this
can
one
just
here?
give a quick run through it. Again, the definition of quality, Ken has already alluded to it. It came from the work of George Nicholson and Benjamin Graham, the renowned Benjamin Graham, teacher of Warren Buffett and many others, very successful investors. But again, the types of things, strong balance sheets, financial strength is important. Earning stability, we like straight lines, consistency, dependability of results on the timeline of history for a company. And then growth and profitability. The size of the pieces of the puzzle is just artistic. All four of these are important. How will the company grow and how profitable will the company be versus its competitors? Those are the four pieces of the recipe, if you want to call it that. If you want to dig in and see a little bit more about the teachings of Nicholson and Graham and where this all comes from, you can actually go to that link. It's a public link at the bottom that will spend a little bit more time. The point I want you to take away from tonight, though, is it's unemotional, it's almost robotic, and we think it can trigger some interesting defining moments. The other thing we want to make the point, we talked about the most important tool for portfolio management being the stock selection guide. For quality, it's the stock comparison guide or industry study, however you want to think about it. The quality rating for any company is a function of an industry study and comparisons, those things we just had on the previous slide. And so it's a stack of stock selection guides or stock studies when it comes to the quality. And you can see the quality for Costco wholesale up at the top there. Again, an EKG, if you want to think of it that way, almost a continuous flat blue line in the excellent quintile. Again, among the top 20% of all companies. So again, it's the comparisons made in that mode that are most important. So again, another company that's given us a little bit of trouble, and this one misbehaved a bit. We like to share the companies that misbehaved. Like Ken said before, we're watching for the ones that dispel or don't act the way we want. Amongst those 134 examples of case studies that we went through, uh, we found one exception where if we'd have followed the relative price performance, uh, Oracle actually came back and did pretty well. It's the only one of the 134 that actually misbehaved and actually behaved and did well. Here's another one where Under Armour, the stock price actually took off and went down before um, the quality actually sagged on the right hand side of this chart. But again, it suggests a company that is not healing very well. And again, this notion of busting through these thresholds could be something important for us to think about. So Under Armour did not survive the subsequent challenge during a future roundtable, again, because the fundamentals were weakening.
Yeah, and here's a case where that trigger wouldn't have helped us. Here's a case with Mesa Labs where the trigger again would have helped quite a bit. You see, Mesa Labs had a quality line that was flat for about a year and a half, 2 years. Slightly upward trend prior to that, and then suddenly we have this big dip back in the beginning of 2017. Notice that after the stock takes a dip from somewhere around 230, 235 down to 140, 150, you can see that it stabilizes for a while. And during that stabilization time, we could have gotten out at somewhere between 140 to 150. If we waited, however, we noticed that the stock price starts to move down even more. This is not a absolutely current picture of Mesa Labs, and we'll be updating this slide to see what's happened in the last 5 or 6 months. Has the quality turned around? Has the price continued to sag? But if you can get out of that tick mark that Mark made there with the red pen, that's a $200 price. And I'd certainly rather get out there as the quality starts to fall 10 or 12 points than get out at the 140, 150 mark or at the 125, 135 mark. Again, I'm trying to save my capital. And sometimes when a measurement is triggering something, I should at least draw this to the front of my mind and think about what might be going on. Mesa Labs is a great study for you to take a look at historically, because you'll see that the margins were under extreme pressure. You'll see that return on equity started to have some real significant issues, and you'll see that there was a lot of financial manipulation going on to prop up the earnings per share. Remember, a company can do a number of things by manipulation to keep earnings per share growing, even when sales might be starting to flatten a little bit. One of the biggest things they can do is buy back shares of stock. So this is an interesting study for you to take a look at, and we think that if we would have followed the trigger, it would have preserved a significant amount of the capital gains that we had made in the stock, because Mesa Labs in the roundtable portfolio was purchased quite a ways back on this graph when the price was in maybe the 55, 60, $65 range. And we had significant capital gains in Mesa Labs, and trying to preserve those capital gains was just as important as preserving the capital.
Yeah, and this is another one where the price drop has not been dramatic yet from my perspective, but Um, even back towards where I drew that inflection point on there, um, Mesa Labs growth was stagnating a little bit. Their profits were down a little bit, but not so much that you would think of it as a terrific drop in quality until you start comparing what was happening at other peers and competitors. And basically these guys were sliding a little bit, backsliding a little bit during a period when their peers and competitors were actually ratcheting up. So they were actually getting stronger balance sheets, higher profit margins, etc. So again, this notion of comparison, and then it ultimately did and does seem to be catching up with the company a little bit. But
Mark, we have a hand in the air. Ann, go ahead with your question.
Hi, this is Ann. My question is, when you're seeing like the Mesa Lab and it drops right before April 2017, but it takes a while for the price to drop more, are you seeing any indication of this in the quarterly trend analysis on the SSG?
There's no relationship between the quarterly trend analysis and the quality rating other than the balance sheet itself. So the simple answer is no.
Okay, because I'm wondering what I'm trying to ask is, are you seeing any like minuses or whatever in the quarterly trend that would show you why the quality might be going down?
No, again, the simple answer is no.
Okay.
Uh, because we're talking about a change in quality rating, which is not measuring the same thing that I think you're referring to some of the PERT reports, and I think that our audience needs to understand that PERT is a document that had its basis in a non-computer age, and it might be showing its age at this particular point.
Well,
So the short answer is no. What, Mark?
one thing that kind of strikes me is it would be a little less granular quarterly, and I don't like to get more granular, but in this case, this is monthly versus quarterly, so could be something there. I do want to take a look at what Ann is suggesting, so I'll put that on the pile of things to scratch my head over.
Okay, Mark, I'm going to answer Bonnie's question right now. Okay, Bonnie says, so there must be certain metrics across all stocks that are looked at for determining quality, right? And if so, what are they so we know what to watch for in our studies? These metrics, Bonnie, are earnings predictability, and almost any source that you look at is going to rate earnings predictability. Down on value line, for example, you'll see in earnings, I think they call it, they do call it earnings predictability, not stability. You can get the same kind of a rating from Morningstar and the same kind of a rating from S&P studies. The second thing that we're looking for that goes across all stocks is this financial strength. And again, you can get a financial strength rating right off of value line. You know, if the financial strength in one report is A plus and the next report it's gone down to B plus plus, I think that's a huge red flag that you might have the quality starting to deteriorate in your company. The other two then are comparisons with a peer group. So you have to kind of look at a peer group, whether it's an industry or a smaller subgroup from that industry, and you're looking at relative profitability. What that means is your company more profitable than average or less profitable than average in the peer group? And then also you're looking at relative growth. Is your company, and this is sales growth, is your company growing its sales faster than the average company in its industry or in its peer group, or is it growing slower? A combination of those four things can be codified and then put into a standardized score, and then it can be changed to a percentile score. And again, I would draw your attention to the reference at the very bottom of this slide. Take a moment and read this article. It does a wonderful job. It's a public article. It's absolutely free. And it does a wonderful job of describing how you can come up with a number. And you can do it as easily as Mark does it. But Mark works at it on a daily basis. If you're trying to do it for only 10 or a dozen stocks, then you know you can put that into a place where you can create your own ratings of quality, or you can use somebody else's opinion. Remember that some of the other data sources also give you some quality measurements too. They like to tell you whether they think the stock is a high quality or a low quality. Just don't confuse quality with something like timeliness on value line.
Okay, well, back to our anecdotes. Here's a timely one, considering that Howard just decided to retire. And it'll be interesting to see how the reaction to that is at Starbucks. But again, just this notion of Starbucks being in the excellent quintile, that between a quality rating of 80 and 100. I think if I were a current day shareholder, and by the way, I am through my wife, and I believe her IRA, what I would probably do is watch to see if that quality drops to 90 and then perhaps to 80. We'll talk about that here in a minute. But in this case, the quality EKG for Starbucks is looking pretty good. And Ken presented this as a roundtable selection just a few months ago when the return spike had spiked up, like he said, to that 15 range. We'd like to see the return forecasts at multi-year highs. So let's talk about this one a little bit. This one just kind of popped up. United Therapeutics. This was either a selection by Ken or Cy back a few years ago, back just after that red arrow. And we'd actually picked it in the This Week update, This Week at Manifest 4 years ago. And back around the time frame shown on the left-hand side of this chart. But what I want to bring to everybody's attention is here is one of those moments where it broke through not just the 80 threshold, but the 60 threshold, perhaps signifying situations with the stock. Perhaps you walked away. Again, you had some time here. You had several months before it actually got a little bit uglier. And then the market kind of caught up with it. So the point we're making is we want to be watching for those thresholds, those break points at 80, 70, 60, whatever. We don't know what those numbers are yet. Ken and I will come up with something as we go forward in this. But avoiding this type of really nastiness would have been a pretty good idea. On the flip side, we talk about going back into a stock which is now trading at a discount to its previous levels. And here's one where the quality trend had actually been fairly strong and in the right direction. And in fact, Cy picked this company somewhere back during these low prices when the return forecasts were up. And again, I think we have the same question again, as it once again has breached or broken through this going from excellent to good, as it says down at the bottom. And maybe that's a situation which can alone be just an indication of potential future challenges that might make sense to wait out. Definitely a timeout type situation. So just food for thought. Again, the quality in many cases seems to be a precursor to shrinkage of PE and problems with the stock price. Any questions or comments that you want to add to that, Ken, before we talk about the alerts?
No, I think we're getting we just have a question from Laura that we'll take at the very end. It's not specifically talking about what we're talking about right now, but Laura, we will get to your question at the very end. I promise.
Well, let's talk about what you can do with manifest investing today, and then we are going to do some stuff related to the relative performance stuff that we talked about in section 2 or question number 2, condition number 2. But for any stock that you own or are tracking, you can actually set some alerts. And you set them by going to the company report page, the research page, and clicking on this edit alert that you can see on the tabs. Okay? And in this case, I think if I owned or were holding United Therapeutics in a portfolio, I might want to know, well, first of all, if it drops below 60 for quality, I would definitely want to do that stubborn check. Maybe that ought to be 70. If it's currently at 78, maybe I set that at 70. I don't know yet. Question mark. I also might want to know if it trends back in the right direction and actually busts up and goes from good to excellent. So I would receive an email. You can see it's actually my account at Manifest. I would actually receive an email if either of those conditions actually comes to pass. And we're going to go down through all of the companies in the roundtable and set these type of thresholds so that we get nudged when a company actually begins to do that fossil type maneuver or the Iconics brand thing or whatever. But fossil would have been a great one to be nudged, call timeout, and make some decisions. So you can actually set these levels. You can also set levels based on the return forecast, as you can see up at the top here. But for this subject, I think we're going to be developing what makes sense. And for many of my personal portfolios, I've already gone through and gone holding by holding and tried to come up with, well, when would I want to know? When would I want somebody to tap me on the shoulder if my stock has a quality ranking of 95? When would I want to be alerted to, if for nothing else, just to check in and do a little bit of auditing? And maybe I set that number at 90 for a company that's relatively steady over the long term. For a company like we just said for Starbucks, maybe you set that quality drops below 90. I want to know about it. So I think this could be a very powerful tool for catching the type of situations we've been talking about here. Any thoughts on that, Ken, as to how you might be using it?
This is a tool that I'm going to be using at great length. I manage an IRA portfolio for myself, one for my wife, and then a personal portfolio, and then a family club portfolio. So I'll be using these alerts on all 4 of those portfolios to help me kind of keep an eye on quality as to what it's doing. I really think that quality is, like you said before, joined at the hip with PE, and I think the whole concept is telling me when a stock is moving to weakness, and as it moves to weakness, that usually means that price is going to eventually move in that same direction.
Okay, so we'll be spending more time, probably have a session specific to alerts and how we're thinking about some of this type of stuff. Certainly something we'll cover in the roundtable, but it's just kind of the tip of the iceberg. And then just to round things out, this is Ken's favorite: make the portfolio better, keep things within range, have the right amount of return, the right amount of quality, the right amount of growth. And here we're bragging about the Mid-Michigan model portfolio, which has done quite well, achieving a positive return of a few percentage points over what, 20 some years now, Ken?
This portfolio, no, closer to 15 for this particular portfolio, Mark, but 15 years at about 2.5 to 3.5 relative return. That means better than the market over about a 15-year period. What's so nice about this dashboard, however, is that portfolio averages box off to the right of the slide there. This goes up on the screen right before our meeting starts, and our folks are looking at these numbers because they know the targets. The par target is always at least 5 points above the market average, and I could see the market average directly above the portfolio averages box. It's labeled my par. So 5 points above that would be 12.3. We're at 12.7, so that's good. Quality above 80, that's our target, so that's good. Growth, this is sales growth. We'd like it to be 11.5 to 12.5, so that's good. We don't look so much at PE ratio or yield, but we do set 80s for financial strength and EPS stability as the target numbers, and these numbers are both good as well. And so after about 18 seconds, most of the folks in our club know that our numbers are good, and we're muttering to each other, just don't mess them up now. We have an hour-and-a-half meeting coming up, just don't mess the numbers up. Don't do something so outrageous to the portfolio that you unbalance what is perceived to be a pretty decent balanced portfolio right now. We use this in a very proactive way. We are SSG based, so those par numbers that are on the dashboard come from an analyst consensus. Mark likes to talk about taking all the analysts that follow a company, locking them in a room and asking them to come up with a single SSG and then publishing the results. That's basically what we're talking about here. We find that our SSGs are reasonable and conservative, and they tend to be within 10 or 15% of these numbers coming up from what the analysts are coming up with. Better investing, NEIC has always suggested that the analyst numbers can be trusted. That's the way they make their bread and butter. What you can't trust are the conclusions that they draw from those numbers. They're constantly looking at the same number and some days saying it's a buy, some days saying it's a sell, some days saying it's a hold. So don't trust the conclusions, but the numbers themselves are usually fairly trustworthy, and especially when you get a consensus number that's based on 15 or 18 or 20 different analysts. That's a pretty decent thing to have going for it. So we use this to make our portfolio better, and we're going to be using some of these triggers to nudge that relative return even a little bit higher. Our long-term goal is to beat the market by 5, but we're very happy where we are beating the market at somewhere between 2.5 and 3.5, depending on the month that we're measuring it.
Well, you know what makes me sad, Ken?
What makes you sad, Mark?
The publicly published buy, sell, and hold ratings, I consider it to be the fake news of the investing world.
Absolutely.
Just crazy stuff. So again, just summarizing for you guys, much of the stuff we're talking about is time honored. It's no different than what we've talked about before and practiced for years. The rule of 5 deployment, I think, is something that's a little bit edgy and new. The concept is certainly not new, but I know I've been part personally and been part of groups that have not been as disciplined as they should be. I can think of companies I have held like Fossil where I was stubborn. And again, we want to just make sure that we're taking advantage of all these tools to again try to pick up a percentage point or two. So this is a work in progress. We will keep you up to date on what we find. We're going to be doing more and more research on different portfolios and this kind of stuff, and you can see some of the stuff there. And with that, I think we'll just close with this slide, and I think we can close down and open up for questions, Ken.
Well, I have 2 questions logged and ready to go here, Mark. If you want to close the program down, and then we'll answer these 2 questions and see if we generate any others.
Okay, let me see if I can figure that out. Thanks, everybody. And again, the slides will be available at Manifest Investing, or you can write to either of us. Thanks for coming out tonight, and we hope that we've nudged you in a way that will bolster your long-term performance as investors. Thanks so much.